is now a good time to refinance your mortgage, right? With everything that's going on with interest rates. You're hearing Lisa, who is coming out saying, Lisa Cook signals that rate cut is not a foregone conclusion, whether they're going to do it or not. Rob, I think you got this clip as well to play by Lisa. But in regards to refinancing your mortgage today, I'm going to read this story to you, and then I'm going to come to you. This is from Yahoo Personal Finance. Is this a video, Rob?
Yes.
Okay, play this clip, then I'll read the story, then I'll go to Barry. Go ahead.
All right, we got some breaking news from Washington Fed Governor Lisa Cook, who is speaking in D.C. Steve Leishman has those headlines. Steve.
Thanks, Brian. The outlook for Fed policy continues to be somewhat confusing, with Fed officials offering different forecasts from each other and even some officials taking both sides of the argument. Lisa Cook says downside risks to employment are greater than upside risks to inflation. However, she says the current restrictive policy is appropriate given inflation above the 2% target. Every meeting, she says, including a December meeting, is a live meeting. Meanwhile, San Francisco Fed President Mary Daly said the Fed needs to bring down both inflation and support the job market.
We need to continue to put downward pressure on inflation and keep our policy modestly restrictive, but not hold the reins so tight that we injure the labor market unnecessarily and give people lower inflation but fewer jobs.
Okay, so is this, I thought it was going to be just going straight to the clip. Is this a good time for me to refinance my mortgage today?
Yeah, it's an excellent time if it makes sense from a rate perspective. For the last 3 years, two things have happened. People have taken out mortgages at higher rates, but also approximately 59% of them, when they purchased a home, they use something called mortgage insurance because they put less than 20% down. Now, thankfully, we've had home price appreciation. One of the great things about it is now you could refinance your home to a lower rate, you could save the delta in rate, and then you could either reduce or remove the mortgage insurance, which means that you can actually save hundreds of dollars. Most people don't look at the mortgage insurance savings that they can get also in conjunction with rate. So yeah, I think it makes an enormous benefit if you could save $300, $400, $500 a month to refinance now. It's real money. And for those people who say, well, maybe I'll wait because rates will come down. Now, I do think rates come down as well, okay? Nobody knows for sure, but I think there's reason to believe we will see lower rates on mortgages. But if you wait to get that extra $30 or $40 a month, it means you're losing the $300, $400, $500 a month savings you could be taking advantage of now.
Got it. Okay. So, and then the other question I'm going to come to you is this one. Risky loan from housing bust era is making a comeback, okay? If you, Rob, is this a clip that goes into it? What's this clip about, Rob? If we...
this is another Yahoo Finance clip.
Is it immediately getting into it? Okay, go ahead and play this clip. Yeah, this is good.
Well, adjustable rate mortgages, which fell out of favor in the aftermath of the financial crisis, are catching on again. Here with the story is senior housing reporter Claire Boston. So Claire, to start here, what exactly is an adjustable rate mortgage?
Hi, Allie. So as the name suggests, an adjustable rate mortgage, the interest rate can change over time. Typically these days, you get either a 5, 7, or 10-year period where you have a fixed rate on your mortgage. And then after that period expires, if you're still holding that mortgage, the rate will start to adjust based on the prevailing market rate. So that means it could go higher, it could go lower. In exchange for taking on that extra interest rate risk, you can often get a lower rate than what is available with a 30-year fixed. Right now, 30-year fixed rates are 6.3%, 6.4%. Adjustable rate mortgages will be around 5.8% for that 7 or 10-year period. So there's savings there if you're willing to kind of stomach that risk.
Okay, so if you want to pause it right there. Now, this is not no income, no assets.
No, she's got it all wrong.
Negative AM. Okay, tell us.
She's got it all wrong. So she's thinking about negative AM, like you said.
Right.
Those are the risky types of loans. And then the risky underwriting guidelines are exactly what you said, where you're not verifying income, asset, down payment. So she's got it wrong. Adjustables, the only reason they went out of favor is because we had an inverted yield curve. The Fed raised rates so much that now you have an inverted yield curve where shorter-term rates were above long-term rates. Now that the Fed's been cutting, longer-term rates have come down, but now you have a spread between them. So the reason why we've seen a doubling in the amount of applications on adjustable rate mortgages is because they make sense. As she said, you do have a savings. Right now, 0.5%, 0.5% for 7 years. A 7-year fixed period, that amount of savings, if you consider that, it's significant. For example, Pat, on a $500,000 mortgage, you'd save about $18,000, $17,000 in the first 7 years guaranteed. But what nobody looks at is, this is something that people should look into, is a lower interest rate mortgage like an adjustable would have compared to a fixed, it amortizes more rapidly in the first few years. So you pick up another $5,000 in equity amortization. So now you've got a significant sum of money, let's call it $22,000, guaranteed in the first 7 years. What happens after that is what people worry about. And everybody looks at worst case scenario. But that's betting against something that is very, very improbable. Could it happen? It could. However, what's more probable is that you look at, let's say, a 40-year history, and let's say that rate goes to somewhere around 7%. 6.96 is the 40-year history of where a fully indexed, meaning what it would adjust to, rate goes to. In that particular case, you would never eat into the savings of the first 7 years. So I believe it's a very good option to look at. And it shouldn't be something that is vilified, like she said, oh, risky mortgages, if you could stomach it. This is something that really can make sense and get somebody into that home, help that affordability issue, because that's the key. Get there so you can create some of that wealth.
Tom, where are you at with this?
Well, I'm with Barry right now, and it's actually a little bit wider. So I'm glad he was a little conservative in his 5/8 of a point. It's actually 3/4 of a point to a point. Right now, 5 and 1. What that means is you have one interest rate for 5 years, and one time at the end of the 5th year, you have to now reconcile, and your bank will send you a notice, and you change your interest once. Not negative amortizations, not any of the negatives that go with it. Or 7 and 1. You have 7 years, and one time it adjusts. Those are adjustable rates. Really, I've always felt that you need to make clear, but they're looking for clickbait, they're looking for views, they're looking for their news. Oh, the ARM is back, the terrible ARM is back. No, it's not. And right now, we are looking at a 70% chance. And by Lisa Cook, when she took time away from defending herself for having 3 primary residences, in a little action that she's got with the federal government, is sitting there talking about this. The dot plot right now, which is one of the measurements of the intent of the Fed, has us at a 1/4 point for December. And there's the CME FedWatch tool this morning was all the way up to 70% chance, up from 61% chance 1 week ago at the time that the Fed spoke. And so it looks like we're going to get another 1/4 point. So right now, Pat, people could be looking at the opportunity to get a 5.0% 5-year ARM one-time adjustment mortgage that makes getting into a house much easier. And if you have the discipline to say, hey, I would have been paying about another $700 more, I'm going to save that. Now you're saving
or apply it towards principal, or apply it towards principal,
or make the payment anyway. You could do that. Hey, set it up for my payment and take another $500, apply it to principal. This is how people can now look at home ownership, not just through what can I barely afford and get into, but a sensible thing. Now, I agree about pricing, and one of the things on pricing is supply, and we need regulation to come down so that builders can build more, because the supply was also what will bring prices down.
Mm-hmm. So a couple of things. Lisa Cook, she pretty much echoed Chairman Powell's thoughts on it's not a foregone conclusion, monetary policy is not preset. So we understand she's just echoing that. But what she also said was that the job market is solid, which I don't know how in the world she could possibly say that. We got the ADP numbers today, and the ADP numbers, if you look at it for this month, it was pretty dismal at 42,000 job creations. However, if you look at the last 3 months in aggregate, and you say, what have we constructed in aggregate, because the last 2 months were negative numbers, there's a a grand total of 10,000 jobs in 3 months in the United States that were created. That is not a healthy or solid economy. People that are on unemployment benefit. We got a bunch of charts if you just want to roll through them just real quick, just 1 second on each. So if you go to the second one there, right there. Okay, these are job openings. You can see where the chart's headed on job openings. Then you take a look at the next one.
What do you mean by that? Jobs?
This is job openings and labor.
Job openings. So people are getting jobs. They're getting hired. They're getting
ads for jobs.
Okay.
Now, another thing, Pat, that people don't realize is that the way that this report is constructed is it's not the U.S. government does it in one shot across the board. They go to each state and they say, how many job openings do you have? The reason that's important is because before work from anywhere, if you put an ad in, it'd be a local ad. But now I could put 6 different states where I wanted an employee. So this is a grossly overstated number. And even while it's overstated at the 7.2 million, look at the trajectory, pretty clear. Next chart shows you once you get let go, look at what's happening. It is harder to find a job. So people are staying on unemployment benefits longer. And remember, in most cases, you fall off after 6 months. So the number is even much worse than this. The next chart shows the ADP report, which we just got today. So you can see the last 2 months were below the red line negative. Today's was above, but when you take the three combined gives you a grand total of 10,000 job creations in the United States. That's unacceptable. We have a very big concern in the labor market.
You're making the argument to say lower the rates.
They have to lower rates because we are so
by
restricted.
How much? By a point or two?
So there's a formula for it. There's a formula that says you take the rate of inflation and then you take something that's a little artistic. It's called R star. And Tom knows exactly what I'm talking about. And R star, Stephen Myron, who is a Fed governor appointed by Trump, he thinks R star is 0.1. You take John Williams, the New York Fed president, he says it's 3/4. Most people in the middle. So even if you said it was 0.5%, okay? So that means that the neutral rate for the Fed funds rate would be at 3.4. So we're roughly 0.5% above neutral. But I think the way that you started at 2.9 is fictitious. And here's why. I think when everybody says we're obsessed with inflation, it's too high, I believe that they're absolutely wrong. They don't understand how to read it. Some quick things. Rob, would you mind possibly pulling up the very first chart? And here's the rate of inflation as measured by the Fed. They look at personal consumption expenditure, PC. They look at the core rate, and they say it's 2.9. We need it to be 2. It is too darn high, right? But when you take a look, even Chairman Powell says tariffs, they're not inflation. It's a one-time price adjustment. Now, Chairman Powell thinks it could be up to 0.5%. I'm being conservative. 0.3%, so that's an overstatement. Even the Fed chairman agrees that there's an overstatement. OER stands for Owner's Equivalent Rent. Pat, this is the most ridiculous thing out there. And Tom, you know how this works. This is a survey. So a survey, and here's the literal question. If you own a home, the question is, how much could you rent your home for today, unfurnished and without utilities? Pat, I don't know how much I could rent my home for. Okay, I don't know who does. Okay, and then measure the change month to month. It's insane. But yet this makes up 1/3, by far the largest component in CPI and 14% of PCE. The number that people
and they use Zillow estimates, and Zillow will all tell you that they cannot describe how they do the rent conversion, because you look at a house, this house for sale would rent for this. They can't describe how they do that.
But they do have good data. So, for example, the survey that the Fed looks at and uses, and the BLS uses, says rents are going up at 4% a year. This methodology has been in place since 1985 without a change. Now, in 1985, you didn't have Zillow, you didn't have Apartment List, you didn't have Cotality, you didn't have the data from Fannie Mae. All of those things say it's actually sub 2%. But if you take 2%, the difference between 2 and 4, it's enormous, because that means that on PCE, we're overstated by 0.3%. It's just a BS number. And then the worst one is portfolio management, and nobody looks at this thing. Portfolio management, if you put your money in with a fund, mutual fund, or with a broker dealer, whatever it is, let's say they charge you 1%. Now, if they went from 1% to 2%, clearly that's inflationary. But if the stock market's going up and you're making more money, but as a result, their 1% is a greater amount, the BLS says that's inflation. How could they possibly say that? Think about it in reverse, Pat. Think about if we had really bad inflation in the supermarket. Here I am, I go shopping, and I look, oh my gosh, all this inflation. And then I come home and I open up my mail and I see my statement, and let's just say in this case, the stock market's tanking. And because the stock market's tanking, my portfolio management fee is less. Now the Fed comes out and says, you know what? There is no inflation because we got the offset from portfolio management fee. I mean, think about the ridiculousness of this. So inflation right now is really at 2%. That's where, and that's at the Fed's target. So the Fed should get off their obsessiveness with this silly idea that inflation's too high, and they should worry about the job market, which affects most Americans.
Correct.
Yeah, but I wonder what percent of this is attributed to the Fed's rates being too high. I mean, don't get me wrong. I think that it's crazy the way the Fed does things. I think they're politicized right now. But we saw this chart that Umberto showed us the other day that shows a deviation. Normally, job openings track the S&P 500, but since 2022, they deviated. If he gets onto that chart, it shows like half of it shows the job openings that you show, but the other half it shows for the first time that the stock market's going up while job openings are going down since ChatGPT was created. So do you think some of this, with the job openings being less and less, could be because of automation?
Well, clearly AI is definitely going to continue to have a big impact. We all know all the big headlines, right? So we know that we're going to see AI replace a lot of jobs.
Yeah.
And obviously there's going to be some individuals that are going to be impacted by that, unfortunately, right?
So would a simple rate cut fix the job opening problem, I guess is what I'm asking?
What it does is this. It can improve economic conditions. The reason it does that is because if you bring interest rates up, people slow down their buying because people buy with monthly payment, and a higher monthly payment, I'm going to buy less of it. Lower monthly payment, I'll buy more of it. If you stimulate the economy to a greater degree, you may create more jobs potentially to offset some of the losses from AI. So will it stop the AI losses directly? No, but will it offset by economic conditions improving and allowing jobs to be created? Yes.
But what is your solution, though? Okay.
Yeah.
So I'm curious, when you look at this chart yourself, that shows S&P is climbing, but job openings is decreasing. How do you process this?
I think we're in uncharted territory here. I think that I'm not a big fan of government intervention, but I'm also not a libertarian because I think there are some useful cases for the government. I think this is something that is going to require a lot of thought and attention to avoid a UBI situation being necessary, because how do you get around this? Jobs are becoming more useless. There are a lot of jobs that are BS jobs that are going to be automated. I think companies, rather than aggressively hiring, are going to be aggressively automating. So like I said, I don't think there's a clear, easy fix for that, but I think eventually we'll get to a place where new jobs are being created. But
the way I process what you're saying is UBI, right? You're suggesting that the government intervention, government's got to come in and get involved. He's suggesting a different way of doing it.
No, I'm suggesting that it's a problem that a lot of thought and effort's going to have to put into to avoid UBI.
I fully agree with you, but what can you put into it to avoid UBI?
That's a difficult question, and I don't even think that I don't even think we have low inflation right now, because if you look at the core spending of people, energy, housing, and food, all three of those are still going up. So I don't know if inflation is necessary.
And 2026 is around the corner. Craziness is going on. For some of you guys that have big plans for 2026, I will remind you, whatever you do, do not go into 2026 without a business plan. It'll be a big mistake you're making. There are way too many moving parts. Every year when we do the business planning workshop, I openly talk about what threats and events we're concerned about happening the next year. We openly share with you, here's what we're looking at. Here's what we're seeing as possible enemy. And here's what we're seeing as an operator, the opportunities that exist for us. And we openly share it with you. We share with you how we're growing our YouTube channel and our media company, what our consulting firm is going. We're sharing our strategies with you. If you're somebody watching and saying, I'm sick and tired of playing small, I want to take my life and my business to the next level, the business planning workshop on December 12th is for you. But number two, if you're somebody that's running a business and you are already a millionaire, we have a lot of people that watch this content. You're doing 10 million a year, 100 million a year. Maybe you're doing a billion a year. You got a couple thousand employees, but you've gotten to a point where you're bored and it's repetitive. And it's just kind of like you're doing the same thing over and over and over again. This is a very, very good event to even wake you up as a leader of the company. So quietly, you can kind of get on the business planning workshop. It's not something that you have to be physically here, from anywhere in the world. So if you haven't yet registered yet, click on a link below. Get registered. December 12th, let's spend an entire day together. We go through a 200-page manual together, which everybody will get. Or you can go to bpw.betdavidconsulting.com. Again, bpw.betdavidconsulting.com. Looking forward to seeing you guys there on December 12th. If you enjoyed this video, you want to watch more videos like this, click here. And if you want to watch the entire podcast, click here.